Is Samantha LaDuc. I am founder of LaDucTrading.com, also LaDucTradingEdge.com. So I have a more geared retail product as well as an institutional product, and also CIO of LaDuc Capital LLC. So my thing is very much market timing calls. And that's basically what I'm trying to figure out is what's next. We've just come from a very large correction this January. It's actually the biggest that we've had in any January. So it matters. It sets the stage for a market of potential underperformance leading in throughout the next year. And we basically have a drawdown that has occurred 17% in the NASDAQ and about 12% in the S&P. So everyone's very excited about buying the dip and going to all-time highs, taking out the highs. Interestingly enough, just recently I was interviewed by Stock Charts TV where I made a prediction. This was a few weeks ago, before this 21-day, wallop, that I expected underperformance this year, where everyone else is calling for 5,000 and higher. I really feel strongly about this. So I went on and basically presented my views for my 2022 underperformance in SPY, and then specifically, kind of drill down to some of the reasons why I feel like we're going to have underperformance this year. And I think this is tough because a lot of new traders, and a third of the traders are new as of the COVID crash in the past 2 years and the liquidity infusion from the Fed. And just basic and fiscal policy has created a new market, right? So we have a lot new retail traders, and unfortunately, they're only used to stocks going up. And clearly, many have gotten hurt by this underperformance in tech, the tech wreck under the surface. But more to the point, funds are also getting walloped. So very professional traders are getting hit bad in this, systemic and systematic selling that has been going on under the surface of the indices. And then most recently, the indices, kind of crashed. So I want to talk about that prediction and then what goes into that, because folks are a little confused. Like, where are the trend trades? Where are the swing trades? Where are the chases? And I want to kind of address that. I do all three time frames. My gig is that, I support clients who basically want to understand why the market is doing what it does. I leverage a lot of my macro, like interpretation, into directional trades, using options primarily. I'm a professional options trader. I have a trading desk of option traders. So mostly women, but I also have, all disciplines covered, all asset classes covered. So we really can cover a lot of ground on all different time frames. But my focus today, I think, is very much focused on where we go moving forward. And I know this is cheating a little bit. And by the way, anticipating volatility and all that jazz. But cheating a little bit, which is this. We'll start here anyway. This was the Stock Charts TV interview, and I just want to play a little bit of it because the consensus was so bullish. My view was bearish. Now that we've corrected, like 10%, where to from now? I want to kind of like show that short clip, and then I want to go into the details of why I think we're going to have a very turbulent year. So we'll start with the consensus.
I'm expecting the S&P 500 to rise to the 5,500 level, which will be around a 15% gain for the year. The premise for my outlook is that the stock market is likely to climb a wall of worry with rising rates as investors focus on stronger corporate earnings.
It might be against consensus, but I think S&P is going to underperform. So right now, one of my favorite rotations is to time value to growth and vice versa. So I see a growth to value rotation framework for the coming year. Basically, this is one of my continuation trend themes since the summer of 2020. So I have been an inflationista, basically a rates bull bond bear since July, August of 2020. And I repeated this mantra of things over paper. Inflation is sticky in capital letters to clients. So I repeated it enough. And some of the reasons being stagflation. We have supply stress, demand for things definitely outstrips supply. We have too much money chasing too few things. Investment in meeting pent-up demand will drive a lot of these value cyclical plays moving forward. I believe it's also a viable thesis for investment in hard assets over paper. So the backlogs have a while before they're going to get dealt with, and shipping manufacturing breakdowns as well. They have led in large part to inflation expectations. Backlogs have not caught up. Yields, I have a great chart of yields overlaid with backlogs. They point to bond yields needing to catch up. So this is a pressing risk to bond proxies such as tech. So with our monetary backdrop, with 7% inflation, highest since 1982, which I believe is going to, like I said, stay sticky, and the Fed holding interest rates at zero and adding 1.3 trillion in assets to the balance sheet, they're now getting nervous. So inflation is not transitory. They have admitted. They are also very political, and they see an administration that is very worried about inflation into the midterms. So I think that's going to drive political expediency for them to basically work harder to tap down inflation. So that's a reason for the season, I believe, in the Fed regime change of hawkish over dovish because of sticky inflation and politics. I also think that this is going to be a continuation theme for 2022, and the Fed put will therefore move. It has since 2013 taper tantrum sits around 20% lower from current prices, and that's where I think we're going to have an outsized correction, but we'll probably settle back at about 4,400 by year end.
Hey guys, Dave Keller here with Stock Chart.
Okay. I cheated a little bit because I'm like, why repeat myself? I just said something that I thought was really going to matter for the market. We've already corrected 10%. We've already hit 4,400. Heck, we went all the way through it to 4,220 something. The point is, I believe now, obviously, there's going to be a lot of bounces. Obviously, we've gotten into the 200-day. But the fear is that we're going to crash. And I want to kind of go through some of the reasons why I came into that call first and foremost, and then we'll kind of look forward. So first of all, this is my Slack channel that I share with my clients. And you can see that I am very focused on interest rates, right? So housing right now is hot fire flames. It has been, which is contributing to the sticky inflation. And I contend it will continue to until the 10-year gets up about 2% and starts to kind of cool things down. But there's a lot of money out there, and they are buying inflationary assets, real assets. So this is an example where since literally July, August of 2020, I have been, and I say it, an inflationista, because I track this stuff economically, and I'm also just using farm girl common sense, right? Used cars, housing, rents, energy, the whole thing, food. So this is basically a chart of the 20-year treasury yield, okay, going back to the 1970s. And I had signified for clients way back when that this looked like an inverse head and shoulder, and it was going to break out. This is a rate of change on this bottom panel. And I basically am really, really focused on intermarket analysis to be able to predict moves, not just in macro, but also on the micro individual stocks. This one in particular, I've said, is just going to make the world, move. And in this particular case, this is yields. The rate of change obviously triggered yields higher. We had inflation spike higher. And in the meantime, bonds have been really kind of underperforming since August 2020. Gold hasn't gotten up off the mat really very much. And the dollar has stayed pretty firm, but not getting in the way, not headwind, not tailwind. So the point was that yields really were going to matter, right? The treasury rate of change and volatility in the treasury market was really, really going to matter, because I had a thesis also in summer of 2020 that we would have things over paper, that at some point we were going to end the 13-year outperformance of NASDAQ and fashion a regime change in higher rates and monetary tightening. And I was waiting for my chart to trigger, and basically it has triggered. So we have definitely come above. This now looks like an inverse head and shoulders. It's never a directly straight line. I mean, that was obviously some freaks of nature here, but the point is, we have higher yield regime, which is also going to be a big political hot potato because inflation has stayed so sticky. So anyway, long story short, I continue to really track yields. And this is another example of the 30-year treasury yield, also since the 1980s. And by the way, this has been updated since this is on monthly chart, doesn't move like Jagger. It definitely takes time. So we break this channel, we have bond underperformance. That would be a big bad, thing, right? So bond proxies have already sold off under the surface, mid-cap tech, for example, speculative tech. Bonds themselves have not caught a bid because yields are staying very firm with sticky inflation. So that whole concept is one that I really wanted to kind of emphasize, because then it would trigger my growth to value rotation theme. This interview that I gave, right? Or this article that I wrote about, and I believe David made it available for folks to download. I hope so. This indicated to me really early as I wrote this. This was in anticipation of that interview, and then just recently I put it together and actually posted it for this presentation. So trends need to maintain a bullish narrative. They also need to maintain bullish breadth. And for sure, breadth has been deteriorating underneath the surface. And that is something that I check every single day with a microscope. So for me, breadth is the tell. Breadth is the tell. And also cumulative volume, but that's another matter. That's really, really helpful. But for this conversation, as far as trends, breadth has to stay strong. The narrative has to stay strong. Technically, we now have breaks everywhere. And folks are also trying to find out, okay, well, what is going to be a good trend? Do we do some bottom fishing of some of these oversold tech? Do we stay with the safety of commodities and cyclicals and large cap? Because a lot of stuff right now is being repriced as that rotation from growth to value then was replaced with volatility, and volatility reprices everything. So the point is, this has definitely been a durable theme to trade around, and why I basically have to stick with it. My whole core themes of deflation ended with COVID was pretty much not only inspired by this chart, but the higher rate regime, right? With this expectation that the growth to value rotation would pick up speed with monetary tightening, and charts that show me divergence, chart that shows me a trend inflection. Now, this is another one of those, big time frame charts. We're talking from the 1990s, and it happens to be comparing SPX and CRB. CRB is the commodity index. Yes, it has a lot of oil. And yes, energy has been the outperforming sector, this past year, actually into Q4 of last year as predicted, into Q1 of last year as predicted, and it has continued. So now this is one that I'm watching. By the way, this has not been updated, but it's even better, right? So this basically shows that tech, or let's put it, paper over things, and now it's things over paper, is actually outperforming. So I don't see that changing too much. In fact, the fact that we have this rotation for the past few months in growth to value, the fact that we have rates, even if nominal real yields are, seemingly capped right now, and inflation expectations have been dropping a little bit right now on slower economic growth, they're still incredibly sticky, and the problems still exist that we are not going to get through very easily. So stagflation, let's talk about a little bit of this, and then I'll go show you some charts. But trends, typically in cycles, if you will, we've had a deflationary backdrop, right? While bonds have rallied for 40 years, we've had deflation for basically the same period of time. And now that we have this revival, because we're forced to invest in our own infrastructure because of COVID restrictions, China ports being shut down, shipping backlogs, delays, manufacturing woes from semiconductor chips. This is real economy stuff. It's not going to go away. It's not going to be resolved regardless of, Fed monetary policy. Let's put it that way. Regardless of how much fiscal, money gets put in people's pockets, it really is going to take some time. So anyway, this is a big issue where hard assets over paper tech returns is going to take on more prominence because we need it to fuel the real economy. So I'm very much focused on global manufacturing, its breakdown, labor shortage, its causes, Fed tightening, et cetera, et cetera. So I'm using all of this macro as a backdrop. Okay, then that allows me to go in and help clients who are very much focused on their individual kind of interest, which happens to be typically what are the best trends, swings, and chases. But I use all of this as a backdrop. So here are the backlogs versus bond yields. This is a great chart by top-down charts. And I grabbed this because supply bottlenecks, shipping, all of that, they have definitely driven inflation expectations. And backlogs are nowhere close to catching up. And yields, when you overlay yields with backlogs, you can see this fractal also has a big divergence. You'll see that in my intermarket analysis that I share, a few select charts that I'm going to share with you. I have a whole bunch that I do for clients, but in that regard, I am constantly looking for divergences. In other words, is it safe? I know technically what I'm looking for. I know the narrative I'm looking for. I can dig in and, take a look at the fundamentals and sentiment and all that jazz. But the biggest issue is I'm always asking, is it safe? So right now, trends broke down because it was not safe. Breadth deteriorated terribly. From a macro standpoint, we still have the threat of major backlogs and higher bond yields for another year or two, maybe even more. But the point is, that is the pressing risk to bond proxies such as tech. Okay, so I'm always looking for divergences like this, also on smaller time frames. I don't care if it's a 1 hour chart. Technically speaking, I'll show you what I mean. But inflation, but getting back to the macro, inflation expectations have been way ahead of the yields, right? The nominal yields that the Fed has been keeping, artificially low was way, way, way divergent from where inflation expectations were. So now they're trying to catch that up, right? First, the interest rate markets, starts to catch up, but then Fed is going to basically announce tomorrow their plan on how they're going to catch up because they need to stem the flow of inflation expectations to cool certain sectors down. Okay, housing in particular. So we have energy, housing, car, food, wage costs, all of these things are growing up and yields are still flat on the ground. So they're going to reduce their tapering and increase their rate of rate hikes. Anyway, you get the point. So what's going to survive that environment? Because it's going to be tough, man. It's just going to be a tough slog the next year. And I really, if I saw the potential to buy bond proxies tech as a safety play into this year because they're so oversold, I would do it. I would recommend it to clients, but I absolutely don't think that's safe. I think more of the higher yields will pull commodities higher. They benefit definitely real world good manufacturing, and that means large cap value plays. So they will go down less fast in a volatility event like we've had and like we will continue to have. So that's the backdrop. Monetary policy is a really big deal because we have a 7% inflation rate. It's the highest since 1982. We have low unemployment, 4.2 versus 5.8 historical average. We have had Fed hold interest rates at 0%. Well, the market is repricing that now. And they've added over 1.3 trillion in assets to its balance sheet in 2021 alone. That's the liquidity that has helped the market double. So we've gone from literally, 2,400 to 4,800, not literally, I mean, literally, like actually, that's a real print in the last 2 years. So it's not hard to imagine this unwind. The question is how fast. And the recent 21-day pullback has been gut-wrenching for those who were not positioned for that. I did have my clients positioned for that, so we are in great shape. But there are funds. I just got to look at all of the hedge funds for year-to-date performance as of Friday, and that's before Monday's bloodletting. It's a bloodbath. I mean, their returns are in total disarray. So there will be periods of chasing because they have to play catch up. But for the most part, we're definitely looking at yields as the reason for the season, and this valuation, 13 years of, again, outperformance in NASDAQ is because of monetary conditions, because of QE liquidity. So if they're shifting to tightening, what happens will be this transition. I believe what will happen is this transition from high PE, price earnings ratio stocks, to low PE. And those are typically the value and cyclical plays. So just think the growth plays, we can't see this as well. But this is in the article. You can blow it up if you just download it. The point is, these plays are higher than the dot-com bubble. And there are lots of correlations to the 2008, a great financial crisis pullback that we had, because things are happening very quickly right now. But the point is, the Fed is definitely tightening at a time where we have a ton of speculation, that froth that has been taken out of the market in anticipation of the Fed tightening. Okay, we have the revised economic growth, going lower and lower. That's a fear for recession. And we still have outsized inflation prints. So, and it's just not going away. Another reason why I think we're going to have underperformance is this historical move that we've had with active versus passive, which means passive has just won, right? We've had 3 years in a row of double-digit outsized historical gains for SPY, 2019, 20, and 21, and a ton of liquidity thrown at it by the Fed, okay, and some fiscal. But the point is, that is not a return that can withstand. It's not usual, right? We're extremely extended. We're in a parabola. So gold right now is an example that comes to mind. Between 2000 and 2011, we had gold performing about 18% per annum. That's pretty much what SPY has been doing the past 13 in NASDAQ. I think, and you know what happened with gold, right? It fell, and now it's kind of trying to recover that level, and everyone's wondering if it's going to break out or we're going to go right back down. But the point is, it was years of underperformance by gold. I think that's where we're heading with SPY, honestly. Divergences, let's talk about that, because I kind of touched on that. Divergences are this kind of thing. All right, so let me just kind of bring up this chart. I hope it's a little bit able to read. Okay, so divergence is where you have, this is my intermarket stuff that I share with clients, okay? So high beta and low volatility, SPHB and SPLV. You can actually create ratios of this. I happen to do it in stock charts. The point is, in January, okay, all of the, just everything turned. January, February timeframe, the SPACs fell, the Chinese ADRs fell. They gapped down on a weekly and just kept going, and they're still on the ground. They've been phenomenal swing shorts. But momentum stocks relative to SPY, right? The IBB or XBI, the biotech stocks relative to SPY, the internet stocks, the social media stocks, and you know the ones, Pins, Twitter, all of that, Snap, the IPO stocks, so many, the ARK funds, basically relative to SPY, they have been grossly underperforming, okay? So we knew that, and they were phenomenal shorts. So what is holding the market up if SPY was still hanging out? Mega cap tech, your FANG stocks, right? The FANGMAN plus T. So, and I'll show you that because this is another one of divergence, right? So this tech wreck, which we spied early and often, was basically the equivalent of soldiers, meaning the small and mid cap, those explosive, unprofitable growth plays. I like to deem the explosive, unprofitable growth plays. They were first considered explosive growth plays. Everyone had them in a list. You could do no wrong with Unity and FTNT and Net and C, and I could go on, and Crowd and MDB and Upstart, and the ones. Okay, if you've traded more than a month, you know which ones. So the problem is they were absolutely in a protracted downtrend, protracted. And even when I grabbed these charts under the surface, okay, were down between 20 and 80% from their highs. So it was only natural for the generals, the mega cap tech, right, to be tested. And that's exactly what I think we're going to see this week. We have Microsoft after hours tonight. We have Tesla after hours tomorrow, and we have Apple after hours on Thursday. So this period of underperformance in the explosive growth plays is very clear. Now we have to see how the very largest of large cap are going to fare, not just in the fundamental assessment, but in the market reaction. And keep in mind something, because we're not out of the woods, even though we've dropped so precipitously in the past 3 weeks. Mega cap tech makes up a predominance of the market weighting in SPY and NASDAQ, right? So they've sold off into earnings, something that's a great opportunity to buy. I personally have no edge on those 3 reports. I personally think Apple's going to disappoint, but that's it. That's all I've got. So I've got no edge into that reading. I have an opinion about what the Fed minutes will relay and what Powell will say. But again, we can trade after. We don't have to trade in advance of these big momentous, events. Energy tomorrow has an EIA report at 10:30 in the morning. I happen to think they're going to have a big honkin' build because they've had 2 months of draw into the year end. So that could be market moving for oil. Oil is a liquidity mechanism in equities. If we have a market moving event in oil, we can have some volatility in equities. Obviously, the Fed decision tomorrow will be market moving as well. And then, of course, the large cap earnings releases and the reaction to those releases will be moving as well. So honestly, careful. We've fallen into this event, but we're not out of the woods yet. And here's where I'm going from this, concept here of we've had this correction. Is it safe? Yeah, that's what we're going to talk about. From a standpoint of COVID and fiscal, I have to touch upon those two briefly. And it's not political statements, but I have to say they are components because many feel that we're going to climb this wall of worry and go up to all-time highs and spike higher, pretty much akin to 2000, right? We had some massive moves back then. And then everyone's going to time the top just freakingly perfect, and they're going to get out with their heads attached. To that, I say you first. So sentiment right now, we've had a very turbulent 2 years. We've had, tons of fiscal and monetary support. And now we have variants that seem to be calming down on their lethal rating. And basically people want to get back to work, school, leisure routines. They don't want to debate anymore the vaccine's efficacy. They just want to live a normal life. So normalization takes some time. You've seen it in stocks, right? When we have a ginormous sweeping outsized move like yesterday, that was a 3.9 standard deviation move, which is why we had such a reflexive bounce at the close. We have the same kind of thing happen in our markets with sentiment. Everybody loved Chamath last year this time. Now everybody demonizes Chamath this now, right? Like the point is sentiment moves like a pendulum. So I do watch that as it relates to COVID, as it relates to politics, but it's just one more indicator in the toolbox. Political action. Oh my God, they would love to pass something. They would love to, the current administration would love to save their seats into the midterm election. Good luck with that. So I'm not very, what's the word? Not opportunistic, optimistic that they will pass, but there is an effort to have something pass, right? And there's also importance if it doesn't pass. Something I told my clients was going to happen, I was convinced of it, was they would not announce, in other words, Powell would not announce anything related to tightening, or stopping the taper, right? Or increasing the taper or anything about rate hikes until the infrastructure bill was passed, until something positive on the fiscal side, because that is very political, right? It's basically passing that hot potato. Biden blames the Fed for inflation, and the Fed says fiscal has to step up and help the economy. Anyway, long story short, that is it in danger, right now, of replacing the liquidity that's coming out of the market. So I think we can still, if we get any fiscal, that's just basically a tailwind for reflation stocks. If we get any fiscal, I am not holding out too much hope. One thing that I absolutely believe is that we're going to have swaths of volatility. And I mean, we had outsized volatility last year, but they were short, very, very short bursts. They were, like number 1, number 4, sudden volatility surges, but they were very, very brief. And then the market went right back to, buy the dip, buy the dip, buy the dip. And at a certain point back in November, I said, nope, everything is short the rip now. I have completely changed. Everything's short the rip. And it was because of my growth to value my rotation work that showed me at the end of November, we were firmly moving out of growth. So right now, my intermarket was the tell, but I also grabbed this recently from Bloomberg where it said, which was fascinating, okay, that literally when Fed came out and removed the word transitory, they weren't going to say transitory anymore. Boom. My growth to value rotation signal triggered. And I remember it was November 29th. And I went, what the? But this is literally, it showed the same thing on Bloomberg when I grabbed this. I thought that was fascinating. But literally, back in November, it triggered and it is still in play, which is basically that transitory is out, inflation's going to be here. And now they have to figure out what they're going to do in how to fight it. Oops, sorry, hold on. And that's the risk we're at right now. In fact, I'll share with you a little bit of my market thought that I shared with clients. Okay, which is right up, the whole 3 weeks. I basically have been saying, why hedge what you're selling? That's the mantra in the institutions and such that are hedging margins, whatever, margin calls, whatever, because there didn't seem to be a lot of put buying until the end. And I kept telling clients, don't buy puts when you need them. So that is another reason why I was really very, very focused on this deleveraging event that was happening. And again, we went from growth to value. And then when there's no rotation anymore, in lieu of rotation, you will have volatility. We had outsized volatility. So then we had the January options expiration. It was the largest one ever. So 3.3 trillion, right, came off the board. That's a lot, largest. And then Monday, of course, we had this collapse, and then we had this reflexive move back. But here's the double jeopardy that I think we're in. Okay, so double jeopardy just means Fed removes mention of inflation as transitory, and market immediately rotates from growth to value. And then when rotation ends, we get volatility on cue. Like, that's my job. I have made a career of timing volatility and sector rotation. If nothing else, that is how I have been able to do my intermarket analysis, interpretation, and my market timing calls. That sector rotation and volatility. That's it. That's all I need. and the rest is stock picking and technical analysis. But this is FOMC coming into tomorrow, right? In addition to the 3 big tech announces. But here's the conundrum. Inflation is sticky, and I contend it will continue to be despite inflation expectations coming down, right? Which basically expecting Fed to follow through on their threats to tighten, and nominal yields looking capped, like I just mentioned. Still, if the FOMC were to allow long-term inflation expectations to become unanchored, it would then have to respond aggressively to re-anchor them at 2%, which could put the economy into recession. So double jeopardy isn't just referring to, economic slowdown and a tightening monetary regime, but it's also the fear of going into recession. So I hadn't really thought about that like this time last year. This is all brand new. Like it's moving so fast since November. It's crazy. All right. So, and history shows, despite a particularly poor performing January for S&P, it can bottom early in the year if the US does not enter recession amid headwinds or the federal government passes meaningful fiscal stimulus. Okay. So DataTrek, by the way, is just an awesome source. And that's what I am basically same idea, right? So now we have basically all kinds of action in the market of intraday bounces. And here's why, and I want to show you that chart. But first, yeah, that was it. That's just my conclusion of my article. So basically, synchronization of buying every dip the past 2 years has been stunning. At some point this year, the buyers will step away and let gravity take hold. Bingo, that happened. Given that about 1/3 of them, by the way, halfway there, the Fed put, I think, is another 10% lower. Given that about 1/3 of investors are new and margin buying has seemed to peak and start to roll over, I would contend that 2022 will set the stage for problems that will test our new trenders and our old 40-year-long macro framework. The Fed put has moved, and since 2013 taper tantrum, I would wager it sits about 20% below current market prices. Please keep in mind this was an interview when SPY was at 4,800. We're now at 4,400. Okay, so basically an accommodative Fed reduces volatility. This is the money quote right here. Okay, this is the money quote. Basically, an accommodative Fed reduces volatility. A tightening Fed, by definition, triggers it. So with that, value should lose less than growth at the very least, if not outright, straight out outperform. All right, so that is my prediction for 2022, which is early, and I loathe to make predictions, but it would not surprise me if we actually overshoot and then come right back up to 4,400. It wouldn't even surprise me if we close at 4,400 and we have nothing but snaking action all year long. So let me show you my charts and what I kind of mean about that. Actually, I might. Yeah, no, maybe not. Okay, hold on. Sorry. I'm looking for a particular level. I didn't have it ready. So give me a sec. That's not it. Okay, forget that. That's not going to work. Where is it? I'm coming. All right, so there we go. All right, so this is SPY. Okay. So this is on a 1 month time frame. Remember how I talked about trends? There was breadth underneath that was breaking down. That was the tell. Intermarket wise, I've got tons of charts of divergence that I can show you, but I just wanted to show you this kind of one look for technical analysts who are into levels and candlesticks and all that jazz. So SPY has formed a very, very large, bearish engulfing is an understatement, but a very red expansion candle. And this is bearish. There's just no other way to put it. Unless somehow we end up doing one of these when the month is over, which is pretty close because we're the 25th, right? See how this little level here got completely saved, right? So if we turn in February, we got to finish the month, but right now this is very bearish. If we actually turn and go straight up, okay, I'm wrong. Otherwise, this is outsized selling. This is de-risking in one very minute picture. We're going all the way back. And I don't know if you heard Grantham say 2,500, but it was really funny. I was looking at this chart the same day going, actually, in COVID, we hit near 2,000. That 2,500 is actually my mean chart, pretty much, this 2,700. Anyway, the point is, I'm just looking for 4,000, and then we can bounce back up. And it's not going to happen tomorrow. It could be a quarter or two. But my point is, we definitely have some trends that have busted. And when you pull out and look, you can definitely see the same kind of damage under the surface. Same thing with the Qs. This is definitely retracing, 7 months of gains in 21 days. So they got a little busy. Having said that, funds are way under their benchmarks. There will be chasing for outperformance. There's no question in my mind. So even though trends are broken, I want you to keep in mind this picture. Okay, this is part of my intermarket stuff. Really not rocket science, but you got to know to look for it. Okay, this is NASDAQ and SPX, another one of those ratio charts on a monthly. Why should I care about monthly? Because once we come up into an area of prior resistance, I take note. And this little, blurb here is really basically a fake breakout and a fast failure. And the whole structure is a head and shoulders. Now, I don't know where we're going to go and when. I suspect we're going to retrace this channel in time. But I don't see a market of outperformance in NASDAQ for sure. I also see my, here's another kind of growth to value, IVW and IVE, basically this rotation, firmly in a growth to value rotation, okay? Basically, it doesn't mean we can't bounce like we did yesterday, a perfect bounce at 14,000 on NASDAQ. But then look what we have right here, the 200, right? So we're going to go smack dab right into it pretty darn soon. So these are bounces that are reflexive into resistance. It's going to be really tough. I think we're going to have a very, very choppy, very snaky. I don't think this is going to be V-shaped into 200 maybe. But I think these images paint a little bit more fear, more than the wall of worry. They actually paint a very clear, this is solid selling. These, once we broke out, this is a COVID crash, just so you know, Pfizer vaccine and all that stuff. We went sideways into the mean. We went a little bit sideways, but into the mean. I mean, we were just perfect. That's a broken trend. That's busted. I've been just straightforward. That's on the mean. But you can see how you want to trade with the trend. And now you can break this down to a weekly, same idea. But we have broken the trend. There's no question. So now what's going to happen? I'm watching definitely the oil markets, energy. I'm definitely very focused on volatility. This is basically a stacked chart with VIX, and then this is 3-month VIX, and this is SPX. So I still think we have an opportunity for VIX to move higher over the period of earnings season and beyond, even though we have huge corporate buybacks with an open window to buy. They got much cheaper prices. Let's see how much it actually props up the market. But big picture, I'm looking at this NYSE chart, okay, which is 2,000 issues over, again, many, many decades. And this has just outperformed. And divergence, again, that divergence with the DIE, you can see where this is. I should actually do this. You can see where, it's one of my alerts. You can see where this divergence, right, of MACD, whereas price is moving higher. Yeah, that's not sustainable. So sustainability for me is when you have stuff aligned, and I can show you kind of like on a smaller time frame what I mean by that. Let me see if there are any questions also in chat. No, Danny, regarding that article, David posted that article that we sent him in a PDF. Yep, he's got it in chat. Danny, sorry, not David. Okay, so here's an example of like, I like to count cards kind of thing for trading. These are just some old level. I just want to kind of show you what I mean by that. For example, yeah, no, this is not it. I got to go back to my snag it. Such a bother. All right, I'll find it and then I'll show you what I mean. But for right now, I see no, hold on one second. That's going to take a while too. Well, what I'm trying to show you, it's not letting me bring up. But it's this kind of thing. So I'm always studying breadth, right? I'm always studying breadth and how it aligns, for example, okay? So you can see back in October, let's do it this way. We had a crossover in MACD, not only from this oversold level, but also in the histogram, also with price, also with my McClellan summation, both NASDAQ and SPX. So I had actually recommended to clients on October 9th, where we would be on the, I give a price for where I think we're going to be on Friday. Some people like to do the pinning action. Anyway, so I give a Friday price. And then once we hit that Friday price, I give my next prediction. And I predicted we would move 200 points higher. And they're like, what? We moved 200 points higher because it was like counting cards. Everything was aligned. Okay. Right now, we don't have any of that. Let's just put it that way. We are not in a place where it is safe. Same thing, I use all kinds of other indicators. And again, this is a little bit more sophisticated, but it's all intermarket. It all has to do with divergence. And this is divergence, right? This happens to be another indicator. SPY is way the heck up here. This was back November, and my ratio was rolling over. Okay, and I said it's only a matter of time before SPY catches down, and that's exactly what happened. So that aside, I want to answer any questions too, but let me just go over a few other things. So sector rotation, in lieu of sector rotation, there will be volatility, no question about it. Some are pointing to valuations as a big deal, and they are a big deal, but there's so much built into this with sentiment and liquidity, right? Like Fed liquidity, not just fundamental earnings, but earnings definitely matter. So I wanted to show this chart that I actually just tweeted earlier today, which I thought was really interesting. So since the pullback that we've had the past 21 days, valuations in the top 100 for NASDAQ have dropped from 30 to 25. Impressive, huh? That's why folks are expecting a bounce, and corporate earnings will beat, and everyone's very excited about buying this. I actually am very nervous that we lose this level and we come right back down to the mean. And I think that's exactly what's going to happen this year. So for me, I see valuation as, okay, super. That's really, that's consolidation or that's distribution. Which is it more likely? I think it's distribution. I think we're going to come back down. That gives me less encouragement to buy tech as a trend trade. I will swing trade it and chase it. That's totally different. But that's really the point where I think we're not really going to crash per se, but digest. And this year will likely be more of a snaking, the great slinky. So maybe I can kind of show this a little bit. Give me a second. The great slinky. All right, so here's an example. Markets, anything above the 200 is good, below is bad. You've probably heard that expression before, right? So why do I think 2022 is going to be the great slinky market? Because we have clearly broken down and taken out. This is not a daily time frame, and it's straight S&P. I've tried to remove as much, noise from it as possible. But the point is, sure, we can bounce solidly, not a question. But what typically happens and go through your charts on a daily with your 200 day. This happens to be the 200 day simple. But the point is, you'll see this overshot and then overshot and then overshot and overshot and overshot until it decides. So this becomes very difficult for trend traders. You want a nice, solid trend, even if it's a little bit, moving. Like, for example, CF, for example, this is an agriculture play, right? It comes back to the mean, it breaks out, it comes back to the mean, it breaks out, it comes back to the mean, it's trying again. So you want a trend that actually has a relationship with the mean, it stabilizes, and then it moves higher. So there are lots of trend plays that I like that happen to be in this kind of category of large cap value. But for SPY, I think we're going to have a little bit more difficulty. I think we're going to have basically this slinky market around the 200. Now, hopefully it won't turn into like an arc. So here's an arc, okay? So arc, and I want to kind of show you, this has been a great short. We overshot, and this is basically all, remember my intermarket where I showed you everything in January, February started coming back down? K-Web, all that stuff, right? SPACs, I could go through this, every single one, EVs. Okay, then it comes down, it gets closer to the 200. It goes, this is the 200. It shoots through the 200. It gets above the 200. Look at, this is the great slinky market for ARK until it starts to weaken again. Now 200 is clearly breakdown level, right? And then look what happened since. Protracted downtrend. It formed a little wedge here. Let me get rid of that very obnoxious little fib level. Okay, never mind, I can't find it. We come down into this wedge, and so now we're on a tighter time frame. My suggestion that we were going to hit and break down to the 200 week and then 76, and now we're having a bounce. But after this bounce, I think we head down to 60. I don't think ARK's done. But prior to that, my point is the great slinky market, we can have some period of underperformance in the SPY. It's basically my main kind of point there. The 200 day basically acts as a magnet in a nutshell. Okay, so the holdouts we are clearly aware has to do with the mega cap tech, also semis. Let me show you semis because I mentioned that in Twitter that I was actually going to show you semis, so I better. Here's simple SMH. Let me just clean this up. Okay, this is a gorgeous reversal pattern right back down to the 50 week. And for those who are technical traders on a swing basis or trend basis, you definitely got to love the 50 week. Okay, so this is a 50 EMA. So many stocks are down. Sectors, stocks, and indices are down. By the way, so is SPY. There's the 50 week. Shot through it, got right back up. Perfect save. Okay, so there's a problem though. Look at semis. For me, this was a really great sign of, okay, we broke out, we had tons of distribution, formed a Morningstar reversal, tried to get above the Keltner, couldn't, broke the 10 week, and I mean decidedly from that 300 all the way back down to this breakout level, down to the 50 week. We bounce, here's the channel of indecision. We roll over to the next level, which is basically 230 or the 100 week. So these types of patterns, you're going to see them everywhere. Oh my God, Microsoft. Look at this. I mean, that was just a fabulous short. I only had some, originally this 305, which is clearly where it broke out on a weekly, and then it continued down to the 50 week. It has earnings tonight, by the way. I've got no edge into earnings. But the point is, so many of these charts right now are coming into the 50. The problem is, will 50 hold? Now, the other area where everyone has been holding out has been basically XLE and oil. Oil has been a fabulous hedge on inflation, but it's getting really extended. So that's where everyone's holding out. At some point, we're going to have a pullback in energy. That's really the low-hanging fruit, since everything right now seems to be trending, and that's why I see some risk. Let me just get that real quick. So if I go through my trend lists, which by the way is a proprietary, I'm able to scan all stocks and indices and come up with the top 60 items, right, that are firmly above their 10-week EMA and they're doing, really, really well. ZGNX and KSS don't count because they were acquired this week. So we got to rule that out. But the point is, you can see how many are in the energy sector, right? A little bit in basic materials, financial services, consumer defense, right? Healthcare sector. What is all this stuff? It's not tech. Now bring up any of these on a weekly chart and you're going to say, oh, that's where I should be fishing. Okay. So that's my watch list for 2022. My predictions, I should say, for 2022. My watch list is for clients. This is where you can find me on Twitter at Samantha LaDuc. You can also find I'm not even sure where my website, well, there it is. Okay. At Samantha LaDuc. You can find my website here. I have a few services. I actually have 5 products. Okay. So starting from kind of new retail traders or newish or youngish or momentum driven-ish or whatever. This is my Discord product that has phenomenal moderators and analysts that are doing their own trading. They're sharing it. They're also holding hands when needed or helping manage risk when needed, but it's definitely short duration momentum trading for new traders for the most part. So definitely check that out. Tons of great channels. Premium channels includes my market thoughts, my chases. I have a wonderful desk of traders. Most recently added Dom for his weekly options and ES levels. I've got Suda for futures, Rithika for her Elliott Wave, Archana for her advanced options, Tiffany for risk management. You get the idea, right? So I've got a fabulous Discord product. Obviously, you get in my fishing club membership, me. I run a live trading room every morning and afternoon. All of my market thoughts, all of my intermarket, all of the client Slack workspace. It's kind of cool. For those who are into automated trading signals, I have also a set of risk indicators. They are housed on VigTech, but you come here and, it's literally 40, 80 bucks. And it shows you 300 ETFs and when to buy and sell. So intraday and swing trading. And last but not least, very excited to soon be announcing, I've done this kind of informally, but now I'm doing it officially. I have a client who's joined me. I'm so thrilled. So Craig has been a client for years. He's a hedge fund manager, and he is going to be providing that excellent macro insight as well as the personalized service for more of our institutional clients, Bloomberg chat and the whole business. Aisha is just phenomenal with fundamentals. I also have an oil trader who's going to be joining, Bob McMinn. And if you follow me on Twitter, I've mentioned him before. He's pure oil trading genius. Anyway, we have a really, really deep bench, okay, and 5 different products. So that's it. I wanted to answer any last minute questions and then basically wish you all a fabulous rest of the week, especially in anticipation of big earnings. It's not a crime to kind of like sit on your hands and wait until the smoke clears. But I definitely want to just wish you a great, happy new year and stay safe this year. Obviously, I definitely want to, just encourage you not to overtrade. I think it's been really easy and it's going to get harder. I think this is definitely going to get harder. So let me know if you have any other questions. Otherwise, I'm just going to turn it back over to David and Anka and say thank you again. And that's it.